Selling your UK family business? In the next few minutes, you'll know what April 2026 means for your tax bill.
If you sell your UK family business after April 6th, 2026, the tax bill will be tens of thousands of pounds higher than it was just a few years ago. This timeline shows the rising cost of business asset disposal relief. For decades, qualifying gains were taxed at 10%. That rate has already climbed to 14%, and in April 2026, it spikes to 18%. Combined with a 24% standard capital gains rate and new caps on inheritance tax, the cost of exiting is at an all-time high. My tax accountant provides the technical mapping needed to quantify these specific exposures and align your assets well before the legislation takes effect. Because tax rates are now tied strictly to your completion date, delaying your exit strategy by even a few months carries a literal price tag. Consider David and Sarah. They own a UK manufacturing firm and are planning a £3 million share sale in May 2026. If they follow the same exit playbook used in previous years, they will trigger a massive, unnecessary tax liability. The new rates will absorb a significant portion of the retirement fund they spent decades building. David and Sarah's situation illustrates the hidden financial danger facing every UK family business owner currently approaching an exit. Here is the baseline tax calculation for a £3 million sale in 2026. The first £1 million of the gain is taxed at the 18% BADR rate, costing £180,000. The remaining £2 million falls into the 24% capital gains bracket, adding another £480,000 to the bill. Compared to historical rates, the loss is stark. That same £1 million allowance used to cost just £100,000 in tax. By selling in 2026, David and Sarah face an £80,000 gap on that allowance alone. To recover this wealth, we look at the first professional strategy, the pre-sale spousal share transfer. By transferring shares early enough to meet the 2-year qualification period, David and Sarah can both claim the relief. This doubles their lifetime limit to £2 million, allowing more of the sale to stay within the 18% bracket and saving £60,000 in tax. Proactive restructuring is the most effective way to blunt the impact of the 2026 rate hikes. Buyers often structure deals with an earnout, a promise of deferred cash paid out if the business hits certain performance targets after the sale. This creates a specific trap. HMRC taxes the estimated value of that earnout at the point of sale, but any additional cash received later is taxed differently, as a chosen action. A chosen action does not qualify for the lower 18% rate. This forces all that excess cash into the higher 24% bracket, regardless of your remaining lifetime allowance. There's also a balance sheet trap involving non-trading assets, commonly known as the 20% rule. If a business holds more than 20% of its value in excess cash or investment property, it can lose its trading status. If that happens, the business forfeits bad PAR entirely, and the whole sale is taxed at the maximum rate. Deal structures are full of these compliance tripwires that can void your expected tax reliefs if you haven't planned years in advance. For owners looking for a different route, the Employee Ownership Trust is a viable alternative. Under current rules, only half of the gain from an EOT sale is subject to tax. For a higher rate taxpayer, this creates an effective tax rate of just 12%. For those prioritizing employee welfare and wealth preservation, EOTs now offer a significant mathematical advantage over a traditional private sale. To achieve these results, David and Sarah must follow a strict timeline, purifying the balance sheet, executing spousal transfers early, and filing their claims correctly. When we compare the final net proceeds, the results are clear. By applying these specific strategies, David and Sarah successfully protected hundreds of thousands of pounds from the 2026 tax trap. Splitting ownership in this way also secures their inheritance tax protection. Because they both now hold qualifying assets, they can each utilize their £2.5 million allowance, shielding a combined £5 million from the new inheritance caps. This video is for educational purposes only. Tax laws vary based on individual circumstances and require professional review. To protect your life's work, contact my tax accountant for tailored advice. Call 0208 570 8531. Email info@mytaxaccountant.co.uk. or visit www.mytaxaccountant.co.uk. The 2026 tax landscape makes expert navigation mandatory. Subscribe to the channel to stay informed and reach out today to secure your family's legacy.